All right, so get this right. We're diving into this scenario where something happening over in Japan could set off like this chain reaction, hitting Bitcoin, the U.S. stock market, and maybe even boosting this cryptocurrency, XRP. Sounds kind of wild, no?
It is a fascinating theory, yeah. And that's really what we're here to kind of unpack today. We're dissecting this expert's analysis to see if it's just like a wild theory or a glimpse into a plausible future.
Okay, so this isn't like a stack of articles. It's one in-depth piece. And the question is, like, could this actually even happen? And then, like, what does it mean for anyone? Even if they, like, aren't, like, a crypto fanatic or something, We're talking Japanese loans, stablecoin regulations, even, like, a potential link to the price of oil.
Yeah?
So, like, buckle up.
Yeah, I think let's start with the foundation of this expert scenario. And it's this thing called the yen carry trade. So imagine, right, you're borrowing money in Japan at these like super low interest rates. And then you're taking that money and you're investing it in, let's say, U.S. assets for higher returns. I mean, that's kind of the essence of it.
So it's almost like taking out a low-interest loan to start a business?
Yeah.
Like using borrowed money to try and make even more money, but like on a global scale or something.
Exactly. But instead of a small business loan, we're talking tens of trillions of dollars. So this isn't just someone's side hustle. This is a massive force in global finance. And the expert is suggesting that this huge flow of money could be disrupted and it could create this ripple effect.
Okay, so that's where it gets interesting. What could disrupt something that like massive? Are we talking like Godzilla attack levels of disruption?
Not quite Godzilla, but the expert points to rising interest rates in Japan and a strengthening yen as potential triggers. So like as the yen gets stronger and borrowing costs increase, you can imagine these investors who borrowed yen cheaply to invest elsewhere, they might find themselves in a bit of a tight spot.
Right, so that low interest advantage they were banking on, like suddenly, poof, it's gone, right? So what do? Just cut their losses and run?
Well, they might be forced to, especially if they need to repay their yen loans. So imagine this scenario, right, where these investors, feeling the squeeze, they start selling off their U.S. assets like stocks and bonds en masse.
Hold on. So we're talking about like a fire sale of U.S. assets. I mean, that doesn't sound good for anyone holding those assets, really. So what happens next?
Well, think about it. A massive influx of U.S. assets hitting a market all at once. It could trigger a significant drop in their value, potentially impacting everything from stocks to those U.S. treasuries that are usually considered this safe haven.
Okay, now I'm starting to see how this like domino effect kind of works. But so far, this is all traditional finance, right?
Yeah.
So where does Gitcoin, like the wild child of the financial world, where does that enter the picture?
Well, the crypto market, especially Bitcoin, it's still relatively young, right?
Yeah.
And it's prone to reacting somewhat dramatically to global events. So a sell-off in U.S. assets, particularly those that are seen as these safe havens, well, it could spook Bitcoin investors, leading to a decline in its price.
So you're saying fear in the traditional market, it like spills over into the crypto market. Okay, yeah, that makes sense. But isn't Bitcoin supposed to be this like decentralized independent thing?
Well, in theory, yes. But in practice, it's still influenced by global sentiment and investor behavior. And remember, a lot of investors, they use leverage to buy Bitcoin. They're borrowing money to amplify their potential gains.
Leverage. The double-edged sword of investing, right? So as Bitcoin drops, those leveraged positions, they become riskier, potentially forcing those investors to sell even more Bitcoin to cover their losses, right?
Exactly. It creates this cascading effect.
Driving the price down further. And this is where the expert introduces this unexpected element into the mix. Stablecoins, especially those pegged to the U.S. dollar. Okay, stablecoins, as in like those cryptocurrencies that are supposed to be, well, stable, right? This is where it gets a bit mind-bending for me. What do stablecoins have to do with all of this? Well, there's been a lot of talk in the U.S. about regulating stablecoins, requiring them to be fully backed by cash or cash equivalents, which, seems reasonable, right?
Yeah.
On the surface, for sure. I mean, who wouldn't want their stablecoin to be actually stable, right? But I'm guessing there's a catch here. Like, what's the potential downside?
Well, one of the largest stablecoins, Tether, holds a significant portion of its reserves in, you guessed it, Bitcoin. Now, if these new regulations are implemented, Tether might have to sell off some of its Bitcoin holdings to meet those requirements.
Wait a minute. So we have like potential instability in traditional markets impacting Bitcoin, and then like regulations potentially forcing a major stablecoin to sell off even more Bitcoin. It's like a double whammy. This is getting complicated.
It is, but bear with me because it gets even more interesting. This is where XRP enters the picture.
Okay, finally, we've been teasing XRP since the beginning. I'm all ears. How does XRP factor into this whole like financial thriller?
So remember where we left off, like a potential Bitcoin crash triggered by events in Japan, and regulations potentially impacting stablecoins like Tether. Well, this is where XRP could potentially come into play.
Okay, but I'm still a bit fuzzy on like why XRP specifically. Are there other cryptocurrencies that couldn't like fill that same role? What makes XRP so special in this scenario?
Yeah, that's a great question. And it highlights a key insight from the experts' analysis. They argue that if Tether faces difficulties due to regulations, XRP could step in to provide liquidity on cryptocurrency exchanges.
Right, liquidity. That's the like lifeblood of any market, right?
Yeah.
But couldn't other stablecoins
Yeah.
or even Bitcoin itself handle that?
Well, the experts suggest that XRP might be uniquely positioned due to its speed and low transaction costs. Remember, if Tether has to sell off Bitcoin to meet these regulatory requirements, it could create a scramble for liquidity on exchanges.
Oh, so it's like everyone's rushing for the exits at the same time, and they need a fast and efficient way to like get their money out.
Great. Exactly. And the expert believes that XRP, with its ability to handle a large volume of transactions quickly and cheaply, it could become the go-to cryptocurrency for traders who are seeking to navigate this turbulent period.
Okay, that's starting to make sense. But even if XRP steps in to like provide liquidity, wouldn't the damage already be done? I mean, we're talking about a potential Bitcoin crash, instability in traditional markets.
Yeah.
So how could XRP possibly benefit from all that chaos?
Well, the expert argues that this increased demand for XRP, as traders seek this safe and efficient haven amidst the storm, well, it could drive up its price significantly. They even suggest a specific price target for XRP in this scenario.
All right, don't leave us hanging. What's the magic number?
Well, the expert believes XRP could surge to $589.
Whoa. $589. I mean, I knew the expert was making a bold prediction, but that's a huge jump. What makes them so confident in that number?
It's based on their analysis of XRP's potential role in providing liquidity, overall market dynamics, and historical price movements. Of course, it's important to remember that this is all speculative, and no one can predict the future with certainty.
Right, of course. But even if XRP doesn't hit that exact number, the idea that it could benefit from this like chain of events, it's mind-blowing. It's like finding a golden opportunity in the midst of a financial earthquake.
Yeah, it really highlights how interconnected the crypto market is and how events in seemingly unrelated areas can have ripple effects across the entire ecosystem. But the story doesn't end there. The potential fallout from a Bitcoin crash and the rise of XRP, it could have a major impact on the U.S. stock market as well.
Wait, we're not done yet. I thought we were just talking about crypto. How does the U.S. stock market get dragged into this?
Right. Well, remember those ETFs we mentioned earlier, the ones that allow traditional investors to get exposure to Bitcoin without directly owning it. Well, if Bitcoin crashes, those ETFs are going to take a hit. Their value will plummet.
Right, because they're tracking the price of Bitcoin.
Yeah.
But couldn't those ETF providers just like adjust their holdings to minimize the losses?
Well, not necessarily. ETF values aren't updated in real time, so even if Bitcoin crashes, the ETF might not fully reflect those losses immediately. These are what we call unrealized losses.
So it's like a delayed reaction. Like the ETF is still holding a bunch of Bitcoin. That's suddenly worth a lot less. But it takes time for that loss to like show up on the books.
Precisely. And that creates a problem for the ETF providers. Imagine an ETF holds $100 million in Bitcoin. If Bitcoin drops 20%, that's a $20 million unrealized loss.
Ouch. That's a big hole to fill.
Yeah.
So what happens then? Do they just ride it out and hope Bitcoin recovers?
Well, they might try, but if those unrealized losses become too large, the ETF providers could be forced to sell off other assets, potentially traditional stocks, to cover their positions and make their investors whole.
Oh, so they're essentially scrambling to like raise cash.
Right.
By selling whatever they can,
Oh.
even if it means like dumping stocks. I mean, that could send shockwaves through the entire market.
Exactly. It's like this chain reaction with the initial shock in Japan, leading to a Bitcoin crash, which then impacts stablecoins, potentially boosts XRP, and ultimately creates turmoil in the U.S. stock market.
It's kind of terrifying, to be honest. It feels like the entire global financial system is built on a foundation of like interconnected risks.
Well, the expert we're drawing from would probably agree with you. Their analysis highlights the vulnerability of a system where a seemingly isolated event can trigger a cascade of consequences across multiple asset classes and markets.
It's like that butterfly effect, isn't it? A butterfly flaps its wings in Japan,
Yeah.
and a hurricane hits the U.S. stock market.
It's a compelling analogy, and it underscores the importance of understanding these interconnected risks, even if you're not directly involved in cryptocurrency or global finance.
Yeah, absolutely. We need to look beyond the headlines and dig deeper into the underlying dynamics that drive these markets. But I think we've given our listener a lot to digest already. Let's take a quick break and come back to discuss what this all means for individual investors like you. Okay, so we've covered a lot of ground in this deep dive. We've gone from like the intricacies of the yen carry trade to the potential for a Bitcoin crash, the rise of XRP, and even the ripple effects on the U.S. stock market. It's a lot to process.
It is, and it really highlights the complexity and interconnectedness.
Yep.
Of the global financial system. What might seem like isolated events can have these far-reaching consequences.
Exactly. But let's shift gears a bit and talk about like what this all means for you, the listener. Let's say like you're not a hedge fund manager or a cryptocurrency day trader. Should you even care about any of this?
Absolutely. Even if you're not directly involved in these markets, the lessons we can draw from this expert's analysis are relevant to anyone who has investments or is thinking about their financial future.
Okay, I'm intrigued. What are these universal lessons?
Well, one key takeaway is the importance of diversification. We've seen how a shock in one area, like the Japanese yen carry trade, can trigger this chain reaction across multiple asset classes.
So don't put all your eggs in one basket, as the saying goes, right? But how does that apply in practice?
Well, it means spreading your investments across different asset classes, like stocks, bonds, real estate, and even cryptocurrencies. Don't overexpose yourself to any single asset or market.
Right, that makes sense. But even with a diversified portfolio, wouldn't you still be exposed to like some level of risk in a scenario like the one we've been discussing?
Of course, there's always risk in investing. But that brings us to the second key lesson, understanding and managing your risk tolerance. Are you comfortable with the level of volatility in your portfolio? If not, it might be time to make some adjustments.
So take a look at your investments and honestly assess how much risk you're willing to take. Yeah. Don't just blindly follow the crowd or chase the latest hot investment.
Exactly. And this is where the experts' analysis of XRP gets really interesting. Remember, they suggest that XRP could potentially play a key role in providing liquidity if a major stablecoin like Tether runs into trouble.
Yeah, that was a pretty mind-blowing prediction. But I'm still like wrapping my head around the implications. If this scenario like plays out, what does it tell us about the future of the crypto ecosystem?
Well, it raises some fascinating questions about the role of different cryptocurrencies in a world where traditional financial systems might be under stress. Could XRP or other cryptocurrencies with fast transaction speeds and low fees become even more important in the future? Yeah,
it's like the expert is suggesting that cryptocurrencies, initially seen as this fringe asset class, might actually become essential to the stability of the global financial system.
It's a provocative idea, and it's one that deserves further exploration. This deep dive has really challenged our assumption about how these different pieces of the financial puzzle kind of fit together.
It's definitely been a thought-provoking journey. So to wrap things up, if our listeners take away just one thing from this deep dive, what should it be?
I think the most important takeaway is this. The global financial system, it's more interconnected and complex than we often realize. Seemingly isolated events can trigger this cascade of consequences, and understanding these dynamics is crucial for making informed financial decisions, whether you're a seasoned investor or just starting out.
Well said. And remember, this is a story that's still unfolding. We'll be watching closely to see how these trends develop and what new connections emerge. In the meantime, stay curious, keep asking questions, and never stop learning. Thanks for joining us on this deep dive.